What if I told you that a quiet banking rule, written in technical language and signed off behind closed doors, could change the entire silver market overnight? What if the silver you think exists on paper might not count the same way anymore? For years, traders have moved billions of dollars in something called paper silver, contracts, promises, and leveraged positions. But now, a global rule known as Basel III is forcing banks to treat precious metals very differently. And some believe this could squeeze the system in ways most investors are not prepared for. If you care about silver, inflation, or the stability of the financial system, stay with me, because this could directly affect you. And before we go deeper, make sure to like this video and subscribe to The Monetary Shift so you don't miss what's coming next in the world of money and markets. Basel III is not a rumor. It is a real international banking framework created after the 2008 financial crisis. The goal was simple: make banks stronger, safer, and less likely to collapse. It was designed by the Basel Committee on Banking Supervision and adopted by major financial centers around the world. At its core, Basel III forces banks to hold higher quality capital and more liquid assets. That sounds boring, but inside those rules is something that touches the gold and silver markets in a big way. Under Basel III, banks must classify assets based on how safe and liquid they are. Physical gold stored properly can qualify as a top-tier asset in certain cases. But unallocated precious metal positions, futures contracts, and other paper claims do not receive the same treatment. Now think about how the silver market actually works. The physical silver you can hold in your hand is only part of the system. A much larger part exists in contracts traded on exchanges like COMEX. These contracts represent promises to deliver silver at a future date. Most of them are never settled with real metal, they are settled in cash. This system allows a huge amount of silver exposure to exist compared to the actual physical supply available. Some estimates suggest that for every ounce of physical silver in vaults, there may be dozens, even hundreds of ounces represented in paper contracts. That leverage is what keeps the market liquid, but it is also what creates fragility. Basel III introduces rules like the Net Stable Funding Ratio, or NSFR. Without getting too technical, this rule requires banks to back their longer-term assets with more stable funding. Unallocated precious metal accounts can require more stable funding under these rules. That makes them more expensive for banks to maintain. If holding large unallocated silver positions becomes costly from a regulatory perspective, banks may reduce those positions. And if large banks step back from providing liquidity in paper silver markets, the balance between paper and physical could shift. This is where the fear narrative begins. Some analysts argue that if banks reduce paper silver exposure, the artificial supply created by leveraged contracts could shrink. If demand for physical silver stays strong, prices might need to adjust upward to find equilibrium. Others believe the impact will be more gradual, absorbed quietly by the market. But even if the change is slow, the direction matters. Regulations do not have to cause a sudden shock to create long-term consequences. Sometimes they quietly reshape the system over years. It is also important to understand that Basel III does not ban paper silver. It does not outlaw futures trading. It simply changes how banks account for certain exposures. That distinction matters. Markets adapt. Banks restructure products. New entities step in. However, when the cost of holding something increases, behavior usually changes. That is basic economics. And silver is not just another commodity. It sits at the intersection of industry and investment. It is used in electronics, solar panels, medical applications, and more. At the same time, it is viewed by many as a hedge against inflation and currency debasement. When inflation fears rise, interest in physical metals often increases. Over the last few years, central banks around the world have expanded their balance sheets dramatically. Government debt levels have climbed. Many investors are asking a simple question: how safe is the paper financial system? In that environment, even small regulatory changes can have amplified psychological effects. If investors start to believe that physical silver is more valuable than paper claims, that belief alone can shift demand patterns. Let's step back for a moment. After 2008, trust in banks was shaken. Basel III was meant to restore confidence by forcing transparency and stronger capital buffers. In a way, the rule is doing exactly what it was designed to do. It is pushing banks to hold more reliable assets and reduce reliance on unstable funding. The debate around silver is really about how leveraged markets function in a world of tighter rules. For decades, financial innovation allowed massive derivative exposure to grow. Now regulators are slowly tightening the framework. On the monetary shift, we focus on these quiet transitions because they often matter more than headline news. A dramatic market crash makes front-page stories. A regulatory capital adjustment does not. But sometimes the slow structural changes are what redefine markets over time. If paper silver liquidity decreases, even slightly, the relationship between futures prices and physical premiums could become more volatile. We have already seen moments where physical silver coins carried high premiums compared to spot prices during supply stress. Imagine that kind of disconnect becoming more common. At the same time, we need to stay balanced. Large financial institutions are highly adaptive. If one product becomes less attractive under regulation, they innovate. They create new structures, new vehicles, new workarounds within the legal framework. That is the history of finance. So it would be too simple to say Basel III will suddenly end paper silver. Markets are complex ecosystems, but the pressure is real, and over time, pressure changes behavior. Another angle to consider is transparency. If banks reduce unallocated positions and encourage more allocated or fully backed structures, that could increase clarity in the system. Investors might gain more confidence knowing their metal is specifically held rather than part of a large pooled claim. On the other hand, reduced leverage could mean less short-term price suppression, according to some critics of the current system. That debate has existed for years. Basel III adds a new chapter to it. So what could this mean for everyday investors? First, it highlights the difference between owning a contract and owning physical metal. They're not identical. Each has advantages and risks. Futures contracts provide liquidity and flexibility. Physical metal provides direct ownership, but comes with storage and security considerations. Regulations like Basel III do not tell you what to buy. They simply reshape the playing field on which these choices are made. We should also remember that global implementation timelines vary. Different jurisdictions have phased in Basel III rules at different speeds. Some deadlines have been extended in the past. That means the impact may unfold unevenly across financial centers. London, New York, Zurich, and other hubs each have their own regulatory environment. The interconnected nature of global finance means changes in one region can ripple outward. The bigger story may not be about silver alone. It may be about how the post-2008 world continues to evolve. Governments want safer banks. Banks want profitability. Investors want returns and security. Basel III is one piece of that puzzle, and when it intersects with tangible assets like gold and silver, it captures attention because metals symbolize something deeper. Trust. Trust in currency, trust in institutions, trust in promises. As we move forward, watch for signs like shifts in bank balance sheets, changes in precious metals leasing activity, and differences between futures prices and physical premiums. These are small indicators, but together they tell a story about how the financial system is adapting to stricter capital rules, a story about whether leverage continues to dominate or whether tangible assets regain influence. If you have made it this far, you already understand that this topic is bigger than a single deadline. It is about structure, it is about incentives, and it is about how rules written in regulatory documents can echo through markets years later. On the monetary shift, we believe informed viewers make stronger financial decisions. That is why we break down complex policies into clear, simple conversations. Now I want to hear from you. Do you think Basel III will meaningfully reduce paper silver leverage? Or will banks find ways around the pressure and keep the system largely the same? Share your thoughts in the comments below. Your perspective might help someone else see this issue differently. And if you found this breakdown helpful, share this video with a friend who follows the silver market. Conversations like this are how awareness spreads. The financial world rarely changes in one dramatic moment. More often, it shifts quietly, rule by rule, ratio by ratio, until one day the landscape looks completely different. Basel III may not end paper silver overnight, but it could mark the beginning of a new chapter in how precious metals are valued inside the banking system. Stay informed, stay curious, and keep watching the monetary shift as we track these changes together.